Hello everyone, welcome to ACCA P6 video lectures. We are at corporation tax. In the previous video lecture, the same lecture was recorded for the F6 and P6 students. So I was using the F6 notes. I told you that the same material will be given to you in your P6 notes as well. So now we will go through our P6 notes. All right? Right, so if you could open your P6 lecture notes and come to page number 88 of your lecture notes, please. We were studying losses when the companies incur some losses. So what happens in that case and how can we relieve that? We have seen some of that in our previous video lecture anyway. So we'll see the remaining bits and pieces relevant to our P6. Right, so as you can see on your screen, so it is a trading losses which we have already seen anyway. And the second page is exactly the same, so carry back relief, so we have seen that as well. Now if you come to page number 90 of your lecture notes, it is a new bit, so which we haven't seen in our previous video. So page number 90, it says relief for deficit on non-trade loan relationship. Now what was non-trade loan relationship? I told you in the previous video as well that whenever we have taken a loan and we have used that loan for the trade purposes, interest paid on that loan will be deducted from the trading profits. Whereas if we have taken a loan and we are not using it for the trading purposes, interest paid on that loan will be deducted out of the interest income. And if, say for example, interest paid is more than interest income, then it would be a loss. Now if you have a loss, that can be relieved. So that's what it says. So a non-trade loan interest deficit may be set off against any profit of the same accounting period. Any unrelieved will be carried forward to set off against any non-trade profits of the future years. Right? And just beneath that it says other loss relief. So capital losses can only be set off against gains of the same or the future accounting period, but it is only against the capital gains. Right? And then property losses, property income losses are first set off against any other income and gains for the current year, and any losses still unrelieved will be carried forward to set off against any other income, to set off against any income of the future years. And then it says restriction on loss relief. Now sometimes what happens is that a company was owned by Mr. A and then ownership was changed. So a company was owned by Mr. A and it was incurring a loss. Then the company's ownership was changed, so the B took over the company. So in that case, the company's ownership was changed. So if the company's ownership is changed and there is a change in the business operations as well, then the loss incurred before or loss incurred after that, they cannot be set off. They cannot be set off against the before and after the change of the ownership. Now, say for example, if there was a change and there was a loss before change, that loss cannot be set off against the profits of the after change periods, and like vice versa. So if there were any losses after the period, after the ownership, and them losses cannot be set off against the previous years. I mean, previous year means the years before the change of the ownership. Right, so that's what it says in the notes as well. Carry forward loss relief is only available against profits arising from the same trade in which the loss incurred. Trading losses may be restricted where there is a change in ownership of the company and there is either change in the nature of the trade within 3 years before and 3 years after the change of the ownership. So that is the threshold. Or after the change of the ownership, there is a considerable revival of the company's trading activity. So in that case, the loss relief will be restricted, as I said earlier. If the restriction applies, then any losses before change cannot be carried forward after the change. Similarly, any losses after the change cannot be carried back before the change. And choice of loss relief, we have already seen that as well. That if we relieve the loss earlier, it's better for us. And likewise, if we waste least amount of gift aid donations, it is beneficial for us because we can use that. Alright, so we are going to look at groups now in this video lecture. So corporation tax groups. So say for example, if a company A had, if a company A was parent of 3 companies B, C and D. So company A was parent and it had subsidiaries B, C and D. And then B company had further subsidiary which was E. Right, so the complex group structures like you have seen at P2 exams. So examiner can put a complex group here as well. However, it will not be asking about consolidation and stuff like that. It will be asking about how you can relieve the loss within the groups. Right now, if one company owns another company and then that company owns another company, so they can form a group, and if they form a group, then one company's loss can be set off against the profits of the other companies. All right. So that's the benefit of the group. So what is a group anyway? So it says group relief group. Now we are only talking about the corporation tax, all right? We are not talking about the capital gains tax. Now for capital gains of the companies, there is a separate rules, so there will be separate group for that. So we are only talking about the corporation tax for now. So it says that a group relief provision enables companies within 75% group to transfer trading losses to other companies within the same group in order to set these against taxable profits and reduce the group's overall corporation tax liability. Within a 75% group, surrendering company can specify an amount of current period trading losses. Now surrendering company is a company with a loss and claiming company is a company with a profit. So claiming company does not want to pay the tax, so that's why they are setting off the loss against the surrendering company. Within a 75% group, surrendering company can specify an amount of current period trading losses. So they can specify the current period trading losses. Then it says excess property business losses. Excess property business losses are that they will have to set off against their own trading income first, then only any unrelieved will be the one excess. Right? So that's why it's called excess property business losses. The ones which are not unrelieved against its own profits. Then excess non-trade loan relationship deficit, again the same definition, and excess qualifying donations to be surrendered between UK companies. Right, so it says that capital losses cannot be surrendered for group relief. Now it says that losses cannot be relieved the capital losses cannot be relieved. However, we will see in the next chapter that they can be relieved, but there is a certain criteria. Now this group which we are studying, it is for corporation tax purposes only, the taxable trading profits only. It's not for the capital losses. For the capital loss purposes, there is a separate group, capital gains group. Now they can be set off as well, but there is certain criteria. So for now we will assume that it can't be, capital losses cannot be surrendered for the group relief purposes. Now after that it says a claimant company, the company which has profit, can claim group relief against taxable total profit after using its own loss reliefs. And after that it says that surrendered losses under group relief can only be surrendered against the profit of the corresponding accounting period. So it can only be set off against the corresponding accounting period. Now in some cases, one company might have 8 months accounting period and another company might have 10 months, the 10 months profit. So one company might have 8 months profit, another company might have 10 months loss, say for example. Now in that case, only 8 months profit can be set off against the loss. All right. So if there is a different period, so only the corresponding period can be set off. Only current period losses are available for group relief purposes. So it means that if there are any brought forward losses of a company, although that can be set off against its own profit, but that cannot be set off against other group members. All right. So only current period losses can be set off for the group relief purposes. Brought forward cannot be set off against the group relief purposes. And finally it says losses cannot be surrendered to or from non-UK resident companies. And just beneath that it says consortium relief. Definition of consortium. It says a company is owned by a consortium, also known as consortium owned company, if 75% of its shareholding or more than that is owned by companies and none of the companies hold less than 5% shareholding. It means that 75% of a company is owned by other companies and all of them companies who own that does not own less than 5%. Now if it is like that, then there will be consortium and the consortium relief will be given as well. Now say for example, if one company holds 75% shareholding in a company, then the other companies which, if the one company owns 75% shareholding in one company, then it means that although the company owns 75% in another company and it owns more than 5% as well, it will not be a consortium, it will be a subsidiary. All right, I hope that you would appreciate the fact. So say for example, when one is subsidiary of another company, it will not be consortium company, it will just be a subsidiary. So consortium company means when 75% of a company is owned by other companies and every company owns the more than 5% but less than the controlling interest, all right, so it will not be a subsidiary. If it is a subsidiary, it will not be consortium. Now, consortium-owned company can surrender losses in proportion to the stake of the members of the consortium. Thus, if a member holds 10% of the share in the company, up to 10% of the losses can be surrendered to that member. For example, if 4 companies had 20% shareholding in another company, it means that every company has more than 5% shareholding, and altogether they have more than 75% shareholding. Now, their percentage of holding in that company is 20%. Now, the consortium company's losses can be set off against these companies' profits, but it will be limited to 20% only, limited to their own shareholding in that company. All right, so if that company owns 20%, it will be limited to that. If it owns 30%, it will be limited to that amount. All right, and likewise, it can be done other way around as well. So consortium relief can also flow downwards. A consortium member can surrender its losses. So consortium members who own the 20% or 30% in the consortium-owned company, they can surrender their losses as well to the consortium-owned company. All right, so say for example, if a member who had 25% stake in the consortium-owned company can surrender losses to cover up to 25% of the company's profits. Now, losses cannot be surrendered, again it says that losses cannot be surrendered to or from the non-resident companies, so non-UK resident companies. We cannot surrender the losses against them. So a consortium company is a company which had 75% or more than that is owned by the other companies, and none of them own less than 5%. In that case, whatever their ownership proportion is, loss can be relieved according to that proportion, and loss can be set off against other way around as well. So consortium owned company and consortium members can set off against each other according to their own shareholding. Right? We will do one question about consortium as well anyway. Let's move to the next chapter for now, which is capital gains group. Right, so it says a capital gains group. As I said earlier as well, that capital losses cannot be surrendered against the group's members according to them rules, which we have seen in the previous chapter. But for capital gains purposes, the group definition is a little different than the one which we have seen earlier. Now, in the earlier definition, what was the definition of that? That was 75% shareholding, wasn't it? Now, if you go back to the previous chapter, it says 75% group to transfer trading losses to other companies within the group. Now, if you had 75% shareholding, in that case only the taxable trading profit can be set off. Now, in this case, if you come for the capital gains tax group, now it is at each level there would be 75% holding, and the top company must have effective interest of the 50% in the group companies. So they say, for example, if there was one company A, and then there were B, C, and D, and then under the B, C, and D there were further 3 companies as well. Now, the A company must have 75% shareholding, and then B, C, D must have 75% shareholding in the further companies as well. Now, and the effective interest of the top company must be more than 50% in order for all of them to be in the capital gains tax group. However, in the previous chapter which we have seen for the taxable total profit purposes, now that top company must have 75% shareholding in the further companies, and that top company must have effective interest of 75% as well. All right, so it must have 75% effective interest in the bottom company as well. So it is unlike the capital gains group where it says 50% effective interest on the bottom company. Right, so that is the difference for the capital gains tax and for the taxable trading profits. Now, relief available to capital gains group. Now it says intra-group transfers. Companies in the capital gains tax group can transfer their gains and losses between them. Right, so there is no restriction on that. So companies in the capital gains group make intra-group transfers of chargeable assets without a chargeable gain. It's an intra-group transfer, so which means that within that group they can make the transfer without without the chargeable gains tax being applied. So there will be a group, and if they are transferring any assets between them, it will be at no gain, no pain. So companies in capital gains group make intra-group transfers of chargeable assets without a chargeable gain or allowable loss arising. No election is needed as this relief is compulsory. Now, assets are deemed to be transferred at the price which will give transfer at no gain, no loss, which means the transfer price would be cost plus the indexation allowance, which means that it will be equal to cost. All right, which will mean eventually that there will not be no gain. There will be no gain. After that, it says matching group gains and losses. Now it means that within that group, the companies can transfer their the gains and losses between each other. Now, say for example, if there were 4 companies within the capital gains group, and there was the 3 companies had capital gains and 1 company had capital loss. Now the loss company can transfer its loss to the other group member, and likewise other way around as well. The profit making capital gains tax. Say for example, if one company there was a capital gains, now that gain can be transferred in the loss one as well, the capital loss company as well. All right, so the capital losses can be transferred to the other group member, and capital gains can be transferred as well. So they can be done in both ways. So that's what it means in this one. After that, it says rollover relief. So what was the rollover relief anyway? Do you remember? Now the rollover relief was when you have sold an asset and proceeds of them asset which we have sold, all of them proceeds are reinvested in another asset. Now there were certain conditions of that, of course. The class of asset must be same, and there was period as well, 1 year before and 3 years after that. So the replacement asset must have been purchased 1 year before and 3 years after that. All right. Now for the group CGT group purposes, now say for example, if one company had sold an asset and another company had bought that asset, another company had bought another asset, then for the roll relief purposes, the whole group will be considered as one single unit. Now if, say for example, there were 3 companies, company A has sold an asset, but company A did not reinvest the same amount in another asset, but company C had bought another asset. Now that can be assumed that it had reinvested, because for the capital gains group purposes, all 3 companies are one single unit. So say for example, one company is selling an asset, another company buying an asset, so that can be matched against that one, so which will mean that that has been reinvested in another asset. However, the rest of the conditions will remain the same, that the class of assets must be same, and the period must be also the minimum period also must be fulfilled, which was 1 year before and 3 years after that. So it says rollover relief is available in capital gains group if member of the capital gains group disposes of an asset eligible for capital gains rollover relief. It may treat all of the group companies as single unit for the purposes of claiming such relief. Acquisition by one group member within the qualifying period of 1 year before and 3 years after may be therefore matched with the disposal of another company. And just beneath that, it says degrouping charge of a company leaving the group. Now, say for example, as I said earlier as well, within the group, within the capital gains tax group, the one company will be transferring assets to other company without the capital gains tax being charged. So it will be at no gain, no loss. So one company will be transferring asset, and there will be no gain, no loss. However, if one company has transferred an asset to another company, and the transferee company where the asset was transferred, that company leaves the group, then the degrouping charge will arise. But there is a certain minimum period in which if they leave, then the degrouping charge will apply. So let's read. It says, if a company in the capital gains group leaves the group which it owns the asset, while it owns assets transferred to it by another group member within previous 6 years, then degrouping charge arises. All right. Now, who will pay this degrouping charge? Now, the company which was selling, that company will be paying the degrouping charge, which eventually means the parent will be paying the degrouping charge, right? So how will we determine what will be the degrouping charge anyway? So we would assume that it was not sold at the cost, but we will take actual proceeds when it was sold, then we'll deduct the cost, then the remaining amount is going to be the degrouping charge. Right, so the gain or loss will be calculated using the market value of the intergroup transfer asset at the time when it was transferred between the group companies. This degrouping charge is paid by the company who sold the shares of the departing company. And after that, it says the annual investment allowance in a group of companies. So like a rollover relief for annual investment allowance purposes as well, the whole group will be considered one single unit. So there will be one annual investment allowance for whole of the capital gains group. All right, and they can use whatever way they want. So there's no restriction on that. One company can use all of it, or 3 companies can use between them as well, so there is no restriction on that. All right, so that was our capital gains group. Right then, so that's end of this video lecture. We have finished our groups, we have finished our corporation tax group as well, and we have finished our capital gains group as well. In our next video lecture, we will be doing one past exam question paper, which will be testing our loss reliefs within the capital gains tax group, and also we will be considering the taxable total profits as well. I will see you in the next video then. Goodbye.